QLD, Pro Shares, Ultra QQQs. Look at this. It's gone straight up. It's at the top. I'm going to draw a trend line MMT. And once again, for the MMTs that are not here today and other apprenticeship MMTs, this chart moving forward is that the higher that we go in the actual bull cycle is for you to know that you have to start looking at where the top end of the reversals are going to get. You can clearly see that this is a weekly chart. And one of the things that I'm going to focus on with you is I'm going to go over here to the zoom tool and I'm going to take where the gap started right here. This is the only part that I'm going to show you right there, this leg of it. Now, having said all of that, you can take a look at the first week, the second, the third, the fourth. That's the only real where shorts were covering and people started to chase it, and we finally made it up to these highs. Now, having said that, I'm also going to give you the same reference here on the Dow Jones in the same video, is that if I show you just this leg of it, where the lower end started right here, you're starting to see a level of exhaustion. And here's what I mean. There's your trend line right here, and this is a reversal to that 10-week moving average MMTs. Therefore, we're sitting right on the top of this bar. So let's make sure that we understand where that key support level is. It's right on top of this bar right here where I drew that X. See the wick? That's the 10-week moving average. It's been rising all calendar 2012. Just like in bears, they go the opposite way. They look something like this. As you all know, when the 10-week, the blue line is going down and the red is going down, and you have that ascending value, and you know how to buy the dips and sell into the rips and make money all the way up in the chain here to the highs. But when do the highs get exhausted? In price action. It's very clear that when you take a look at the 2011 price action, that was your first bull pullback in calendar 2011. But then it followed miserably right down here, and now we are at all-time highs, and we took out these key resistance levels where these previous bottoms were being made in the Dow. Now, when you take a look at that and you take a look at the QLD again, they resemble each other, and except this one here has not tested. You can see that it's good to wait this because people chase markets at highs. So when markets do get up at their calendar yearly high, whatever time period it may be, is you looking for this right here, that the lows of these wicks over here in this weekly chart, you can see it starts at, well, looks like it starts at 104 and goes right up to 109 in a weekly wick right there, MMT. So that's this one here, right here. And that's where the buyers came in and the body got up toward the highs. Now, that's the public model. It does, so you understand that part of it, but it's where that electronic high-frequency model was working right at the 104 area, and you'll understand how they wound the ask side. That's where people buy in the level twos. They buy on this side of the market called the ask right here. Okay, so like I'm just giving you an example. So when this side of the market is sprinting and people are buying up on the ask and the bid rises, that's how those breakouts happen, okay, electronically. And there are high frequency computing model machines that get these lows at 104 on the weekly level now, and then bam, they got a $5 move. By winding that up there, that's part of what's been going on at the highs, okay? Because your standard technical analysis is not nearly as reliable as it once was because of the manipulation in the high frequency computing models. And that is where ECNs, electronic communication networks, are developed and match up buyers and sellers within milliseconds. True story. And so there are pricing scripts that could be 80 cents times 3, $2.40. You walk it up on the ask 240 and you walk it back down $1. That's the kind of thing that's been going on in the bid and the ask, MMTs. So, and it's always verified when you see things like that in the Qs especially, they will make a high at some point. And so will this one in reference, the SPY. Look at here. See how this one's pulling back already, MMT, toward its 10-week? What a bullish move it was. And here, it's where it started. Here's that leg, and here's the topping pattern, MMT. Right here, right now. See, the wonderful thing about being here is that you know what you're doing, and you can see right here that you have this big wick on the spider, just like you did on the Qs here. And that is when that bull is wanting to get back into that market, as the older crowd would know it. But today, like I said, it's a high frequency model, computer generated programs that can create these lower price scripts, walk those up there. Now, the thing that you want to do, MMT, the part you're going to want to focus on, MMT, is how the high frequency bottom support levels continue to leverage up in the price that supports that long trade. However, monitoring the SPY and the Qs is a good thing to do, only to get that public bull and bear sentiment reading. And because if the SPY is working great off of that support level on top of that right here, man, as soon as that hit that thing, bam. And it was a certain percent level above the 10-week moving average, MMTs. That's where the high frequency actually takes place very quickly within the exchange model. Bam, and there it goes. And if you're not lightning quick at getting in, you're going to miss most of the move, and you will. And I can only tell you that truthfully now. Now, the other part that I can tell you truthfully is if you know how to have limit orders and accumulate the bottoms on these things, and you can use them as long as that ECN transaction, that's the electronic communication network, is working in your favor, and they're taking the ask higher, and you know what's going on in here, and you have your MMT platform, well, you can't go wrong. However, we start to make tops, we're going to monitor these pullbacks. When they do come down, we're going to take a look somewhere right around in here as where they could bring and test these breakout points, MMTs, that are here. And that starts from this particular line right here. And I want to make it clear that you can see here where the tops are being made. And you can see where that first pullback of that bull right there, right here on top of that support level. And they all look the same now. That's where that lower end of that, and this is a weekly chart, okay? So these are things that we're going to be covering in today's session. And once again, it's called a bull run, bull breakouts to highs, and what they look like. And you can see right here in the video, you can see right there, from this bar down here where I'm going to put that X. Right there, I put the X, okay? That was 2 points. That's that support level of the upper end of the price exhaustion that's building. And you can also break through these resistance levels and hit a final peak in all of them at some point within the yearly calendar high. And today's date is 3/10 of 2012. And you'll notice that the S&P 500 relative to the SPY is diminishing here, where I just kind of drew this little, you can see this top right here. And now, one thing about price action and electronic communication network type systems is when you come down and test that blue line, look at what the percent level was above it though. And that's where the high frequency model came in. Look at that weekly move. But yes, it's a narrow range in price, as it is. Now let's take a look. You can see exactly here at 1340 was our support level that we had called for, and that's getting net long off of that bottom of that bull bounce. Bingo. And look at right here. But take a look, and I'm going to show you something else. I'm going to go to the info panel for you, and I'm going to click right here. And you can see that the high here was 1374.76, and the high over here the prior week was 1378.04, 226, 2012 in that period. This last one here that just passed us by, today is 310, this started 34, okay? And the weekly high is 1374.76, still lower. However, look at the percent level above the 10-week, how the high frequency model came right in. And if you don't know how to start buying those exhaustions, yes, the price is exhausted, but you can tell how the buyers entered again. They're there. Now, mathematically, there are scripts where those buyers and those ECNs can follow each other, and that's how you take advantage of getting net long off of these support levels now. And not only do you get net long, then you got to know when to be cashing them in. Just remember, it's easy to buy something, but you have to know how to limit out the order and all. Make sure that you ring that cash register, then protect your gains. Always want to protect your gains. It's very important. That way you won't reason with yourself, but rather ring the cash register consistently within the bull support levels on entries down below the market. It's a narrow range top. It remains price exhaustion on a weekly level, okay, here on the S&P 500. And so does the Nasdaq comp. I'm going to just show you a little bit here on the Nasdaq comp. Right here. Same pattern. Look at the wick right here at 2,900. Okay, now let's draw a trend line. MMT. And this is live training session for the MMTs. We'll be doing a lot of individual equities today. We'll be doing lots of setups on Sunday morning when most people will be getting the actual execution setups per se in the options market, weekly option market, monthly option market, prices, wholesale bids, lots of things on the calendar that are coming under our new launch. And you'll have all of your titles so ready for you there. Here you go. This is at support level right here. Once again, you can see the resemblance. Here's that X. That's that support level. There's that wick. It got right back above that high. And you can see how that electronic bounce, high frequency models can work. And not only that, it's a bull exhaustion run that started, well, let's just take a look at this right here. Let's come right across there. There we go. Now, only reason why I did that, MMT, is to show you that up here where that trend line is that this weekly body of the bar it's not real robust, but we can still break higher and go up in the delta tree and hit higher resistance levels if they want to break it out, I have to take you back over here. And we have to get back into the 2000 period. These are back in my days. Shorten the highs up here. I was here, right here. Those were the good days. Dot bomb days, coming off of those highs, coming down. Now listen, here's the thing though. It's still part of the yearly cycles that markets can run in. So let us not forget that. This type of bull run would not be out of the ordinary to hit this price level right over here, which is around 3,200, let's say. These weekly levels that were back on 10/29/2000. This was this was all of that October period. I remember it well back then. And there was where that move started to go down. But that's the upper end of that resistance level. There's also another one that's going to come into play, and that's going to be around 3144 area. That's just at the lower end. And then you have, I'm just letting you know that it would not be abnormal to break out higher and come up and hit these areas before you roll over. And an electronic tape that we feel is, whether it's high frequency or whatever kind of terms that people may want to use, we already know what the price scripts are. So there is a way that when you break up in here, we start running into levels like this. And I can just tell you right now, there's that 30/50 handle. You're going to have another one right about here. You're going to have another one on the upper end of another channel, be right about there. So this is that pocket that so you could break up into here. And remember that each high in all of these, and this is a Nasdaq composite, same thing with Nasdaq 100. Look at that topping pattern. Narrow range, but they can still break higher. Now, that 10-week moving average is right there. This wick on a low, that's your support level. So let's go over here. Let's go to the zoom tool. Let's just pull up this little piece of it so you can see where that key support level was within that bull breakout cycle once it got above and held that support level and then consolidated. But what are we looking at is that we're looking at where that price exhaustion is going to be. And this is a Nasdaq 100, by the way, weekly. Okay. And so when we take a look at the core components, we always want to know when we're going to go through stocks like ISRG, which will be in a different video. They're all going to, it was the leadership stocks that took indexes and various different sectors higher throughout Wall Street. There's a lot of big ones that we're going to be looking at. We are going to focus on the Google in the next video that will also be a reference to how the broader indexes and other charts that are overbought will start to eventually in the next 2 to 4 week forward looking period. And so you take 2 weeks from 310 of 2012 to the 4 week cycle period. Within those periods, you're going to see where markets can break higher to those upper resistance levels, MMTs, but then are going to even be that much more overbought. And it's not out of the ordinary. And we will be taking a look at the weekly fear indicators, is how the VIX is related to all of the S&P and the SPDR and what instruments are tied in where. And look at this weekly consolidation down here where there's no fear, and there isn't. And we'll be doing special training with you so that you will know that you've got this weekly consolidation that just hasn't broke. But the lower that this goes, it's possible to go down to 12.5. If you break higher in the key indexes out of these narrow range weekly price action scripts to the upside, then you're going to get down. Look at how high this went on the week. There was some fear this last week. And we'll cover this in a different video with you. But there was some fear in the weekly cycle. All right? Because you're down here in levels where you have very few bears in the market. Everything's okay. It's another way of showing you the complacency. It's a perfect time that the lower that gets, the more, if you're holding things, well, if you are, hey, it's up to you, whatever you do. I know what I do only is I sell into these rallies, because when you sell into the rallies and all of this, and this is a fear indicator, by the way, the VIX. And I'm going to conclude this for an introductory that individual stocks, once they start making highs, you would start to see these intraday wicks start to have big reversals intraday on an intraday entry and exit level, both off of the higher resistance to sell short naturally, but then when you're buying off of the bottoms, and here's that S&P again, 500, and that is also part of it, but you're going to be bouncing like this off of them support levels that I've been showing. And what the percent level above the 10-week is where those high-frequency machines made their move before standard technical analysis. The nice thing about it is stockmarketfunding.com has its own bot system. And what does it do? Well, it tells us who's in control. And when this is going on, you're net long off of the bottoms. Special preview. Indexes, overbought cycles, bull runs, bull price exhaustion, lots of various things to look forward to, how you can break higher to that next resistance level before you would even get weaker in the broader indexes, and what the time cycles are going to be, 2 to 4 weeks. We're in that overbought level, and I showed you the fear indicator. So the fear indicator did come up a notch.